Hi, my name is Paul, and welcome to my monthly portfolio review series where we're 2 months into year 3 of investing $100 of real money each month into Canadian securities. The goal of this series is to emulate the journey of a hypothetical Canadian whose life circumstances will never allow them to max out their tax-free savings account. This year, Canadians are allowed to deposit up to $7,000 to invest within their TFSA, but our Canadian protagonist will only be able to achieve $1,200 over the course of the year. However, despite contributing less than 20% of the limit, I believe that we can get our Canadian protagonist into a position where they'll be able to happily retire off of their investments and live out their golden years in financial freedom. And I think that all it's going to take is the discipline to consistently follow a monthly investment plan of putting money into high quality, easily understandable, and reasonably priced securities. So with that, let's hop right into the 1 month performance of the portfolio's major holdings. Starting off, we have our worst performer and smallest position, Goeasy, which is a company that lends money to subprime borrowers. And usually, this one is growing incredibly quickly. But this month, the share price pulled back by about 2%. Though this wasn't really on the back of any big news, as the only thing to come out from the company was that it will be announcing its Q1 results after the markets close on February the 13th. And their conference call will be held the next day at 11 a.m. Eastern Time. And last month, I didn't end up buying any shares of Goeasy since the price is still trading a bit too expensively considering the business model risks inherent to lending money to people who have a history of bad credit, not to mention the size of the debt pile. Noting that, we did still earn $1.56 in dividends from the shares that were purchased several months back. But I am expecting Goeasy to announce a double-digit percentage point dividend hike in the coming month, which will likely be paid out at the next distribution, because last month marked the fourth quarter of Goeasy paying out 96 cents per share. And the company has a history stringing back nearly a decade of hiking their dividend by an average of over 30% per year. Meanwhile, Goeasy has maintained a payout ratio in the ballpark of 25%, so there's still plenty of room for continued growth, leaving no reason not to expect another strong raise, especially considering the company's impeccable 2023 performance. Speaking of dividend raises, the portfolio's next largest holding, MTY Food Group, has confirmed that they've decided to raise their quarterly dividend from 25 cents to 28 cents per share, which is an increase of 12%. And that's practically in line with the company's historical compound annual growth rate if we eliminate MTY's first ever raise, since that raise was a pretty sizable outlier and makes the growth rate look much better than has normally been the case. Anyway, upon the announcement of this raise, MTY's share price did make a nice little move upwards, ending the month at $58 per share, which is a gain of almost 5.5%. And last month, I did end up buying about 0.6 shares of this restaurant franchisor that I still think is trading well below its fair value, which is good news since any purchases made before the market close on February 5th will qualify for the upcoming payout on the 15th. And since I'm making my purchases on the 2nd, I should be able to get my hands on some shares that will boost the portfolio's dividend earnings for next month, which is a nice little unexpected bonus. Also, MTY is expected to release their Q1 earnings and hold their conference call sometime in mid-February, though they haven't released an exact date or time as of yet. Moving on to the largest position in the portfolio, we have the Morguard North American Residential Real Estate Investment Trust. And Morguard had another solid 1-month performance, putting up a gain of a little over 4%, and that doesn't include the monthly dividend that the REIT paid out. At first glance, it doesn't appear that anything all too important happened this month, with the only news being the announcement of the earnings release date and conference call, which will be held on the 13th and 15th respectively, in addition to the announcement of the REIT's intention to repurchase more shares. However, in the unassuming NCIB announcement, we got a lot of juicy information that has the potential to make some serious waves. First, we learned that under the previous bid, Morguard nearly managed to buy back the maximum number of shares allowed, which ended up being about 4% of the REIT's shares outstanding. Plus, we learned that since the end of Q3, the REIT has repurchased an additional 188,000 shares, which left less than 50,000 of the nearly 1.5 million shares that were allowed to be repurchased by January 9th, though it should be noted that the data in this report was collected on December 29th, so the REIT still had more than a week to continue repurchasing the rest of those shares. Either way, I think it's pretty fair to say that for all intents and purposes, Morguard managed to max out their 2023 buyback program, which is great news. But even better than that is that in the new 2024 NCIB, the management has raised the maximum number of repurchasable shares to nearly 2.8 million, which represents about 10% of the REIT's float, which is huge and might be hinting that the management has some big plans for 2024. And if the REIT does manage to hit their limit for the 2024 bid, we might really start to see the share price and net asset value per share start to converge, which would mean some serious gains for investors. But we're going to have to wait and see what the management has in store and if there are going to be any obstacles on the path ahead. In the meantime, I'm still happily collecting the monthly dividends being paid out and continuing to add shares each month. For instance, last month I added 5 shares of the REIT to the monthly portfolio, which helped to leave it in a better position than it was in the month prior, where the portfolio was down 6.17%. As of the market's close on Thursday, February 1st, the portfolio is now only down 2.21%, or about $57 on the roughly $2,580 of contributed capital and reinvested dividends. But if we just account for the $2,500 that was personally deposited, the portfolio is up by $23.23. Now, before moving on to how my money would have performed if I'd instead invested into some diversified ETFs, I want to note that their more recent performances are pretty heavily skewed by dividends that were received in the last month, as all the ETFs received quarterly dividend payouts except for the Global Value ETF, which received its annual dividend, which amounted to nearly $72. And I think it's worth mentioning that without the dividend, the 1-month gain on invested capital would have only been about 0.7% as opposed to the near 54% gain, which would have shown up if the dividend were included. But because annual and quarterly dividend payouts don't happen every month, I like to factor these out when looking at the 1-month performance specifically. That way, none of the portfolios appear to be crushing the others in terms of performance, simply because it happens to be a month where they're getting paid a larger dividend. With that explanation out of the way, we can clearly see that the best performer of the month was the S&P 500, with a gain of 4.9%. Next, my portfolio was hot on the S&P's heels with a solid 4.55% upwards move. Meanwhile, the other portfolios were a good bit behind, with the Canadian All-Cap Fund moving up about 1%, followed by the Global Value and Canadian Large Cap ETFs achieving similar gains of around 0.7%. So, all in all, the portfolio is 2 for 2 in terms of strong monthly performances for 2024. Unfortunately, we've been having to go through recovery mode from our rough final quarter or so in 2023. Now, the green line here represents how much money my portfolio has gained and lost on a month-by-month basis, and it also tracks how the money would have performed if I'd instead invested it into the previously mentioned benchmarks. Plus, the red line tracks my goal of achieving a 12% annualized rate of return on investment. So, the portfolio is still short of my goal, let alone first place. In fact, the portfolio will need to continue its recent strong performance for a while just to catch back up to the worst performing of the competitors. But on the bright side, it's nice to see the portfolio back in the black for the first time in several months. And the gap between the 12% goal and my portfolio is down to under $300, despite it having been well over $500 at its worst a few months back. So things are really starting to get back on track. Though I've got to say, I do wish I had a little more time to pick up more MRG shares in the $13 range. That said, the REIT is still pretty heavily discounted, and so I'm still planning to buy an additional 5 shares this month, and I'll be putting the rest of my monthly capital into a fractional share of MTY Food Group, which is similarly cheap. Okay, I just received the email confirming that I've successfully purchased 5 shares of the Morguard North American Residential REIT for $15.27 each, and 0.5416 shares of MTY Food Group at a cost basis of $58.73 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, As of the market close on Friday, February the 3rd, the portfolio has 117 shares of the Morguard North American Residential REIT worth roughly $1,804, about 10 shares of MTY Food Group worth a touch over $591, and the same 1.62 shares of Goeasy, which are now worth about $253. Moving over to the dividend tracking chart, in January the portfolio earned $8.16, with $6.60 coming from Morguard's monthly distribution and $1.56 coming from Goeasy's quarterly dividend. So the year's off to a pretty good start, with this being a new record for the most dividend income earned in a single month. And $8 is more than enough to take advantage of this sale on shampoo and body wash. So we're starting to chip away at some of those living expenses. Now, in last month's episode, I did forget to give my prediction for how much dividend income the portfolio will earn in 2024. And I think that because it's only the beginning of the year and the portfolio is already projected to be bringing in about a quarter shy of $10 next month, thanks to MTY's recent 12% hike, and we still have Goeasy's upcoming raise to look forward to, I don't think it's unreasonable to expect somewhere in the ballpark of $130 in earned dividends for fiscal 2024. I think that we're probably already on trajectory to either hit that target or surpass it, especially if I continue finding high quality undervalued dividend payers to accumulate shares of. So $130 is the projection for 2024, which means that in the remaining 11 months of the year, the portfolio will need to bring in about $122 or just over $11 per month, which would be more than double the $5.25 average earned in 2023. But as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $104.08, which is the first time that the annual projected yield has surpassed the triple-digit mark. A huge milestone, marking the point at which we can officially expect to get an extra month's worth of contributed capital just because of the dividends being earned on the portfolio's stock holdings. And all it took was investing $100 per month for a little over 2 years. Now, this is also about a 5.5% increase from what was expected last month, and thanks to MTY's dividend raise, the portfolio's yield on contributed capital has also risen to 4%, which is great to see. Now, before concluding the episode, I feel like I should mention that because all three of the portfolio's holdings are going to be releasing their earnings results within the period of about a week, it is going to be almost impossible for me to cover everything in depth and in a timely fashion, especially since I have a special trip planned on the 18th and I won't be able to record for about a week or so. So instead, the plan is to cover everything briefly in next month's episode. But if there is any really big news that does come out, then it will likely get its own video. It might just be a little bit later than usual. Anyway, I appreciate you all for your understanding, so thanks for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.